Our first speakers to get things started are going to be Dawn Johnston and Ryan Fronius from our tax services group, who are going to provide a current tax update.
Good morning, everyone. Oh, come on, we can do better than that. Good morning, everyone. We've been waiting for 3 years. Let's make some noise. Ryan Fronius, manager of our tax services group. He's presented this to you before. Thank you so much for coming. We are so excited to be live again. 3 years. It's been 3 years since we've done the program. My number one objective today, not to fall off this stage because it's like really close here. My number one objective. Number two objective is to keep everybody engaged, answer a couple questions, talk about some things, and just, one of the things Ryan and I decided to do today is just share a lot of our experiences over the last 3 years. It's been crazy. The last 3 years have been crazy from the tax side. Many changes. Not a whole lot of significant tax law changes with respect to tax rates and stuff like that. But there have been many changes with PPP, ERC, a pandemic, we were shut down, we were working from home. So a lot of new issues that we have today that we never had before. Just to show of hands, how many people have never been to this presentation before? How many people are first timers? Well, not a whole lot. Maybe a quarter of the room. How many people have been here more than 10 times? 10 times. Yeah, look at that. Awesome. Thank you so much for coming back. Not only do we appreciate the fact that you come back to see us, we know you bring your friends, we know you talk about us, and you send us to your business, and you refer us. Alec and David Swisher are doing sound. Make sure you thank them, because if anything goes wrong, they will get it fixed. Like that. Right on cue. But they worked very hard. I know they were down here yesterday tinkering with the system. So, like I said, what today is going to be is just Ryan and I talking about some things that we've seen over the last couple of years. So, I will talk a little bit about the midterm elections, which are 5 days away. And I'll talk about how incredibly important it is from a tax law point of view what happens in 5 days. Whether you're on the red or blue side, doesn't matter. Either way, it's very important. It's very important, so get out there and vote. Year-end tax legislation, I'll talk a little bit about that. I'm not expecting significant tax legislation between now and year-end, but I'm going to talk a little bit about that, why there may be some legislation and why there wouldn't be legislation. Is that better? Okay. Recent tax law changes. When we say recent tax law changes, we're just going to summarize the last 2 or 3 years. We'll talk a little bit about some business-related matters. When we talk about that, we're going to be talking about some of the things that we've seen over the last 2 or 3 years that are very important with respect to our business clients. We'll talk a little bit about some mergers and acquisitions, developments, some things that we've seen. We've probably been involved somewhere between 60 and 80 transactions over the last 3 years, all by themselves. And because of that, there are just a lot of things that are different today than where they were just a couple years ago. And then, to the extent we have time, we'll talk about some individual-related tax matters. So those of you who have been here before know this is my favorite slide. I love showing this slide and talking about it. The midterm elections are 5 days away. And why is it important? From a tax law point of view, from a tax point of view, why is it important? Well, it's incredibly important because depending upon who wins, depending upon who controls the Congress, that significantly will change the future of our tax policy. Right now, as a lot of us know, the Senate is split 50-50. And if you remember from civics class, if the Senate is split 50-50 and there's a vote and it comes down to 50-50, to remember from our civics class that the vice president breaks the vote. So right now, the Democrats control both the House and they control the Senate. And obviously, the Democrats are in the White House. So to the extent that a big package comes through, like the BBB, the Build Back Better plan, once a big program like that comes through, a big tax law like that, you would think that the Democrats would be able to pass it. And you would think that that was the case, but that really did not happen because we had 2 senators who generally vote on the for the Democrats decided that they didn't like this bill for some reason or another. So because of that, because of those 2 senators who publicly said they would not vote for it, that bill did not pass. And because that bill did not pass, those significant tax changes didn't make their way through. So as we know, the Democrats currently control both houses of Congress. A one-seat change in the Senate completely changes control. If it goes from 50-50 to 51-49, completely controls what one party can do. The Democrats win that one extra seat, it's much easier for them to control tax policy. If they lose one seat, it's much easier for the Republicans to stop any changes that they're trying to make it through. With respect to the House, we're talking probably 6 or 7 seats could change. A change of 6 or 7 completely changes Congress. So because of that, it's very important. This next election is very important. And this is not unusual. This happens every 4 years. Every 4 years when there's a midterm election, things like this are happening. If the Republicans take control of both the House and the Senate going forward, chances are we're not going to have any significant tax legislation over the next 2 years, because basically we're going to be in a stalemate situation. If the Republicans are in control, they throw a bill through, the president's just going to veto it. Then it goes back to Congress, and without a 2/3 majority, they're not going to be able to pass anything significant. So unless it's bipartisan, it's not going to happen. We just do not see any situation where there's going to be significant tax law changes. There will be tax law changes, but not the tax law changes that are significant in my mind, like tax rates, corporate tax rates, the things that get all of the press. When the politicians are out there stumping, if you will, when they're out there trying to get votes, they're saying, we'll do this, we'll do this, we'll do this. Well, no, you're not. You're not going to be able to do that without having the majority control. If the Democrats retain control of Congress, both the House and the Senate, what we expect is some tax bills will be passed over the next 2 years. It will not be partisan, right? It won't be partisan, but they will work through the reconciliation process like they did with the Inflation Reduction Act, and they will get something through. What's interesting, though, just like we saw with the Build Back Better, if they have 1 or 2 senators who say no to a particular bill, then it doesn't make its way through. It's very interesting. So I love throwing out interesting facts. They're interesting to me. My wife thinks I'm a nut because some of these things I'll throw out. She's like, why do I care? I'm like, why? That's kind of, I care because it's just interesting. And she just shakes her head. But she knows because I've been throwing some of these goofy stuff out to her for years. So for example, some interesting facts. As we head into midterm election, I don't know if you could think back 2 years, right after President Biden won the White House, already they were talking about the midterms, how important the midterms were going to be. Like, how did they know how did they know 2 years ago that it was likely that the Republicans were going to do well during the midterms? Does anybody know how they knew? Well, the reason they think they knew that is because historically, the president who's in control during the midterm elections, historically, they get crushed during the midterms. The party gets crushed during the midterms. Let me throw out some facts for you. Since 1934, the president's party has averaged a loss in the House of 28 seats and 4 senators. Since 1830, 192 years, since 1830, only 2 presidents have increased their seats in the House and the Senate in 192 years. Any guesses as to which 2 presidents gained seats in both the House and the Senate over the last 192 years? Vic, you pay attention to politics. Guess.
I'm going to say Reagan.
Exactly wrong. Okay. I would have thought the same thing because he was one of the...
Call on me. Give me the answer.
Now, I knew you were going to say that. I expected you to say that. And I think most people probably would have said the same thing. That's what I thought too, but that is wrong. Actually, President Reagan, over his two midterms, didn't gain in either of the 2 years. He gained some in the House, but it's not President Reagan. Interestingly enough, Herbert Hoover, back in the day, some of us were around and voted in that primary. And the second one was Bill Clinton. And Bill Clinton, it was his second term after he was impeached. His second term after he was impeached, he grew his seats in both the House and the Senate. I think that's fascinating. It's fascinating. How is it that happens? You've got presidents who have won overwhelmingly in their second terms, but they haven't increased their seats in the House or the Senate. Also, since 1830, again, 192 years, over 192 years, only 5 presidents have gained seats in the House. That is bizarre. Only 5 presidents gained seats in the House. That is crazy that history, there's that history of presidents being elected and then going backwards in Congress during the midterm elections. I find it very interesting. Basically, the grass is always greener on the other side, right? You know, we elected this guy, made all these promises, never happened. But we're going to try to change things by changing Congress. So, with all of that said, as a lot of people would say, my rant. And I'm okay with that because I just find it interesting, and it does have a very influential effect on tax policy. Because if the Democrats had had more seats in the Senate instead of 50, because we had 2 of their senators did not vote for the BBB, if they had a 4-seat advantage, the BBB would have passed, and we would be having a very different presentation today. Since it didn't pass, a lot of the things that were supposed to be passed in the BBB never got passed. So will there be a significant tax change before year end? We don't think so, because no matter what happens, the change in Congress, if there is a change in Congress, is not going to happen until January. So we're basically in what's called the lame duck session, and it's very difficult if you don't control Congress. And you know, we know that the Democrats control Congress now, but they don't have enough of a majority to get something through without having some senators vote in their favor. And we know the Republicans are not going to do that when it comes to tax law. So chances are, we know that the only way to get it through is through a reconciliation package, which really is very difficult to do. We do expect some type of partisan bill or some type of partisan change between now and probably March of next year, because there are things that are important to the Democratic Party, and there is partisan support for things like some retirement changes, things like R&D. R&D needs fixed. We all know, all of us who work on corporate taxes, we know the R&D needs to be fixed because it has expired. So we don't expect anything significant between now and the end of the year. If a Democratic Party controls the Congress going into 2023, there probably will be some more tax law changes in 2023, things that they could not get through with the Inflation Reduction Act. So recent tax law changes. Ryan, why don't you handle these? Sorry about that.
Sorry.
Recent tax law changes. And again, so these are, when I say recent, these are going all the way back to President Trump's Tax Cuts and Jobs Act.
Yeah, so taking a look back a few years, one of the most significant tax law changes perhaps since 1986 was the Tax Cuts and Jobs Act, which I'm sure a lot of you remember that. Some of the more significant provisions in that was the 199A 20% business deduction allowed for pass-through entities. Also, a decrease in the top individual tax rate that dropped from 39.6% to 37%. And that was a big deal for higher income earners. Another big provision of that was the $10,000 state and local tax deduction cap. Prior to that, there was no cap on what could be deducted for state and local taxes. So that really hit a lot of people hard when it was capped at $10,000. Another item of that was the 100% bonus depreciation rules. Prior to that, it was 50%. Once the Tax Cuts and Jobs Act passed, people didn't expect there to be many significant provisions for a long time after that. However, due to certain changes in the political environment, obviously unforeseen world events, there were actually quite a few changes since then. The Secure Act being one of those. Don, do you want to click that?
Oh, I'm sorry.
Sorry. The Secure Act, that wasn't necessarily a big tax change, but that was one of the more significant retirement reforms in probably over a decade. That, if you recall, that changed the RMD age. It increased it to 72. That was one of the more significant items from that. And the idea for that was Congress really wanted to help working Americans start saving for retirement. There was a statistic, I can't remember. I want to say there were some 17 million Americans stopped contributing to their retirement, which was crazy. So the idea with that was to help Americans to start saving. And then after that, not on the slides, the Secure Act 2.0, that's actually something that is in the works right now in Congress. That has passed in the House. The Senate is, I think there are 2 bills in the Senate that they're working on, the Rise and Shine Act in the EARN Act. That is something that does have bipartisan support for the most part, so look for that to be passed possibly by the end of the year, if not early 2023. And then who can forget the CARES Act? A lot of the different bills that really impacted taxpayers over COVID. That had to do with PPP, ERC, different child credits. Again, not huge tax reform, but it was definitely significant. And we did a lot of work with our clients on the PPP and ERC over the past several years, and we're still doing some work with that as well. The Build Back Better Act, that Dawn mentioned that briefly. This was a big deal because there was a lot of clients in December of 2021 that were making a lot of decisions based on this, thinking that tax rates were going to go up. We were thinking that tax rates for individuals, the top was going to go back from 37% up to 39.6%. We're expecting capital gains rates to increase for quote unquote higher income individuals. A lot of different things with that we thought were going to happen, but it didn't actually happen. So all that planning ended up being that did not get passed. And again, Dawn mentioned previously that had to do, it just got shut down in the Senate. Went through in the House and got hung up in the Senate, and that was dead. Also, the infrastructure bill. This was enacted in November of 2021. Not a whole lot of tax changes there, not many tax provisions, but this did eliminate the employee retention credit that we were expecting to be available for the fourth quarter of 2021. However, that did eliminate that, and that was the end of employee retention credit.
Yeah, and interesting, that BBB, like I said earlier, if you have two senators who vote different way, that act passes, and we're completely doing a different presentation today. We're talking about tax rate increases. And one of the main things was capital gains. They were talking about, and it was in the bill, that the capital gains rates were going to go from 20% to 40%, well, 20% to 39.6% for some taxpayers. I had a few clients who are, invest in companies throughout the United States. They made decisions in June and July of last year to sell their businesses. They made a decision that, okay, if capital gains rates go from 20 to 40%, we're going to take a huge hit. We're thinking about selling the business within the next 2 or 3 years. We're doing it before year end. And I had several businesses that we did close. We closed on the sale in 2021 because they were fearful that the tax rates from a capital gains point of view was going to double. So it's really interesting. And we thought in June or July of last year that it was going to happen because the Democrats controlled both the House and the Senate. We did not anticipate, at least I did not anticipate, that you'd have one or two senators basically says, no, we're not doing this because it adds too much to the deficit. So the Inflation Reduction Act, which was something that was passed not that long ago, signed by President Biden in August of this year, does have some tax changes, and we're going to talk a little bit about those tax changes. For the most part, what this act does is it makes changes to health care and prescription drugs. So, there are a lot of incentives in there to make healthcare more affordable and to reduce prescription drug prices. There's also a lot in there with respect to fighting climate change and taxing what they refer to as wealthy corporations. Even though we refer to it as the Inflation Reduction Act, it's actually not called that because it wasn't allowed to be called that. But it's referred to as an Inflation Reduction Act, and actually the CBO, the Office of Congressional Budget, the Congressional Budget Office, actually said, and I'll quote, "The bill will barely make a dent in inflation in the near term, and it could even nudge it upward," which is kind of interesting. So before we talk about the Inflation Reduction Act, I'm going to talk about a couple things that are not in the Inflation Reduction Act. Basically, this act, the IRA, as we refer to it, is basically just a bunch of stuff they pulled out of the BBB, the Build Back Better Act that didn't get passed. They pulled a bunch of stuff out of it and included it in the Inflation Reduction Act. Some of the things that were not included are the increase in the tax rates. So the tax rates, the highest tax rate did not go from 37 to 39.5%. Changing the corporate rate, that did not happen. Corporate rate didn't go from 21 to 28%, and they didn't change the individual capital gains rates, which is important. They didn't touch estate and gift tax at this point in the IRA.
And they didn't touch the SALT deduction, the state and local income tax deduction for those who pay high state and local income taxes. In the original bill, they were talking about that potentially going from $10,000 up to $70,000, and they decided, that never made it through because there was a lot of political pushback on that. Interestingly enough, they didn't change the carried interest rules, and what I think is incredibly interesting is there's a Democratic senator from Arizona who basically, she's Democratic, but she said under no circumstances will I sign anything that has a carried interest. And then not too long after that, and I don't know if it's true because it was in the news, not too long after that, something came out that she has a lot of her supporters are folks in private equity. A lot of people who donate to her political campaigns are people in private equity, and people in private equity are those who benefit the most from the carried interest rules. Again, I'm not saying that's true, it's just something that I read on the internet, and if it's on the internet, we all know it's true. Also, modifications to the treatment of R&D. They didn't do anything with R&D. That is something that definitely needs to be done because throughout my career, R&D has expired about every other year since I've been in this business. They continuously extend it. They've never made the extension permanent. So that was also not in there. So that's something we do anticipate over the next 6 months with respect to some changes to R&D. Ryan, you want to talk about IRA?
Yeah, so some of the things that are in the Inflation Reduction Act. Healthcare, that's a big one. The extension of the Affordable Care Act through 2025. That was the premium tax credit that's allowed for taxpayers that are purchasing health insurance through the marketplace. Energy efficient home improvement credits. This credit is increased starting in 2023. This part is for windows, doors, insulation, HVACs, heat pumps, and some other items. Residential clean energy credit. So for solar, electric, solar hot water, fuel cell, wind energy, and geothermal. Again, some other things in there. Those are the bigger ones. Also, the clean vehicle credits. I think it's on the next slide. These have been in the news a lot lately. Some buzz around these. The clean vehicle credits. These are credits up to I think $7,500. They're based on the purchase price of a quote-unquote clean vehicles. Now, there are certain limitations on AGI, so once your adjusted gross income gets over a certain level, just like is the case with other credits, those will be phased out. Starting in 2024, there's a mechanism that will allow car buyers to transfer the credit to the dealers at the point of sale instead of taking it with the tax return. Also, the manufacturer sales cap. Some of you may know what Tesla, for instance, the first 200,000 cars that were manufactured were available for the credit. Anything after that previously, the credit has been phased out. So for the past couple of years for Tesla, you have not been able to get a credit. That's because that was for cars that were after the first 200,000. That manufacturer sales cap will be eliminated, I think starting in 2023, so Tesla, that's now on the table again for the credits. Now some tax provisions that are in the Act. The new 15% alternative minimum tax on large corporations. This is something that's kind of been floating around here for a while between politicians. This is beginning in 2023. There will be a 15% alternative minimum tax on large corporations that have at least $1 billion in what is referred to as average adjusted pre-tax net income. Now, this will be based on the prior 3 years, so you'll have to look back 3 years and take an average to determine what that adjusted pre-tax net income is. $1 billion might seem like a lot on a separate company basis here. The important thing is to make sure you're paying attention to the affiliation rules with this, because on a separate company basis, you might be okay. However, once you pull in all the companies on an affiliated basis and look at that whole affiliated group, you could be subject to that 15% AMT. Also, there's a new 1% excise tax on corporate share buybacks by certain publicly traded corporations. I think this was a last-minute add to this act. 461 loss limitations for non-corporate taxpayers. Not necessarily anything new, but this did get extended another 2 years. And what this does is it essentially just limits the amount of losses from your business that you can deduct to offset other income on your personal tax returns. I think for 2021, those limits for single taxpayers was about 262,000. Married filing joint was 524,000. Another item is the reinstatement of the Superfund taxes on credit or on crude oil and petroleum products. This is a permanent reinstatement of about 16 cents per barrel. This will be effective in 2023. Basically, the revenues from this just go into a trust fund that are used to clean up hazardous waste sites, oil spills, things like that.
As far as these changes, I think the ones that affect our clients the most are the 461, the changes in the 461, because we've got a lot of flow-through clients that have tax losses. And those tax losses, like Ryan said, once they're over $500,000, you can't use those tax losses. Anything over $500,000, you can't use to offset other ordinary income, which we've got a lot of clients in that situation. Especially when clients go out and buy a new business. They buy a new business in that first year. When they buy a new business, a lot of times they have gigantic depreciation deductions. Those depreciation deductions, you were able to take those losses in prior years, but now they're going forward limited to $500,000 for those losses. Those losses aren't eliminated; they get to be carried forward, but those are significant to our clients. One of the other things in the Inflation Reduction Act. The law provides for approximately $79 billion to the IRS for an additional funding. Now, how many people think the IRS is run right? How many people deal with the IRS on a consistent basis and just want to bang your head off the desk every time you try to do that? Yeah, we knew the IRS was in a difficult situation 5 years ago. We knew 10 years ago. They are underfunded. They don't have enough people. Their systems are not good, and it's impossible to contact them. The number of calls that they picked up last year, the number of times when the phone rang, they picked it up last year in 2021 was 11%. How many of us would be still in business if we picked up 11% of the calls coming into our offices? Zero. Yeah, so obviously the IRS needs funding, but the question is it going to be fixed? We knew the IRS was in trouble before the pandemic, and the pandemic just made it more obvious that the IRS is in trouble. Before I go on, are there any IRS agents in the room? Okay. I put this on here because I put this on because it was actually a political ad. Right after the IRA was passed, right after President Biden signed the IRA, I saw a political ad that basically said this: the IRS is hiring 87,000 agents to audit you, and you will be at higher risk because of this. It was just a political ad. Obviously, we know a party did that since President Biden signed the law. And I looked at that, I'm like, wow, that's interesting. In reality, there was nothing in the IRA that talked about hiring 87,000 agents. There was something about a year before that said the IRS has a shortfall and they plan on hiring a bunch of people. That does not surprise us. We knew that the IRS was woefully understaffed. So the fact that they're going to hire 87,000 or 100,000 really does not matter. They anticipate there are going to be 50,000 agents retire over the next 5 years. So guess what? They need to hire 87,000 agents. Does that increase the risk of you being audited? Soon after that bogus political commercial came out, the IRS made a statement and said, listen, if you are making under $400,000, the chances of you being audited will not increase because of this. Anybody making under $400,000, the audit rate will be the same as it was before. I got to tell you, what it was before was as close to zero as it could be because they do not audit a lot of individuals. I'm not telling you to cheat. I'm not saying that. They do not audit a lot of individuals. So, good, we'll wait for that. Good answer. So, is it going to help? Is it going to help with the IRS? $79 billion in additional funding, $45 billion for tax enforcement. Is the IRS, is it going to get better? I've been doing this for 30 years. Is it going to get better? Is this going to help? Again, there are no IRS agents in this room, right? I don't think so. I can't imagine it can get better. It is so broken, it's going to take so much to get this thing fixed. And I just do not, I just don't see it getting better. It's more difficult now than it was 2 years ago. 2 years ago is more difficult than it was 5 years ago. 5 years ago is more difficult than it was 10 years ago. So they've got a really, really big problem here. We're going to have to continue to stress. We're going to have to continue to work really hard to get things fixed. And at some point, we determine whether materiality allows us to actually try to fix a problem, or we just have to move forward and pay what they're asking us to pay in situations. I could tell you so many stories that you would not believe with respect to trying to connect with the IRS to get simple things fixed. I spent 8 hours in one day, because we were missing there was a comma difference. I was on the phone, they were asking for the name of the client, ABC Company, LLC. What's the name of the company that's on the tax return? ABC Company, LLC. That's how it is on the tax return, because some tax packages don't let you put the comma in. So it wasn't on the comma, but the IRS agent on her screen had the comma in there. It took us 8 hours to resolve a comma. And that is not unusual. That's the kind of the crazy stuff that we have to deal with. It's very difficult to deal with it, but we move forward. We work as hard as we can to get things fixed. And because sometimes there are big issues and it takes time to get it fixed. I know Bob Grossman had a pretty big issue with a client this past year. It took him about 2 years to get it fixed. Eventually, which is in most cases, we won. We got our point across, and we didn't get hammered with a lot of tax. But it took years to get it fixed. Okay, the IRS, can it get any worse than it is now? I think it can. I got to be honest with you, because they're having so much difficulty finding people. We're all having difficulty finding people. Anybody in the room who's not having problems finding talent, and I'm sure the IRS is the same way. It's very hard to find talented, qualified people. And if they've got 50,000 experienced agents walking away, they're not going to be able to replace those 50,000 in the near term. So it continues to be difficult. So what can you do when you run into problems? There are a couple different options with respect to connecting with the IRS. There's an online account. Actually, I find that online account, your online account, I find it really helpful. I don't do it a lot with my clients because I kind of need to have certain information that I generally don't have for my clients, but I've done it for myself, I've done it for my daughter, and it's been very helpful. So if you want to try something if you're having any difficulty with how much tax or whether they've accepted your return, you can actually go in there and see the last couple years of return, and it's not overly difficult to get on. You have to have a smartphone because you've got to take a picture of yourself and send it to them, and you need to make sure your address is current with respect to the last tax return you filed, but it actually works pretty well. The Where's My Refund tool works pretty well if you're getting a refund. The majority of my clients don't get refunds. We apply, and a lot of my clients are owing money. The other thing, keep calling. If you don't succeed the first time, call more. It's not unusual in my office. If I have an issue, I have one of my staff associates call. They will sit on a line for 2 hours listening to the music repeat over and over and over and over again. And then once the IRS picks up, they'll connect me in. I'll connect my client in if I need to, but it takes time. It's just a lot of time. And then there's a taxpayer advocate service. Government has something called the taxpayer advocate, and that's supposed to be the office where you help. I think it's a good idea. It should be, in my mind, the office of common sense. And you should be able to call and say, we're missing a comma. Can you take care of this? You should be able to do that. The problem with the taxpayer advocate is it's really, really hard to get through to them. Throughout my career, I've called the Pittsburgh Taxpayer Advocate local office at least 20 times. I've never received a call back, and I've never had anybody pick up the phone. Anytime we've had serious issues, we would go to the National Taxpayer Advocate, and we've had some success in doing that. But that's not an easy thing to do because there's one National Taxpayer Advocate. And if you can connect with them and write the right letter, which Bob has done many, many times, they will actually send that information to the right person. Is Pennsylvania worse than the IRS? Is it worse dealing with the state of Pennsylvania than dealing with the IRS? That's not even possible, right? Yeah, it is. It is. It really is. Pennsylvania is a mess. It is so difficult dealing with this Commonwealth of Pennsylvania because they make rules that are not law. They make policies that are not law. So, we also have problems with dealing with Pennsylvania. We deal with every state, and Pennsylvania is one of the toughest states. Pennsylvania and California. California is just aggressive. They're just going to tax you and they'll put liens on you whether they should or not. Pennsylvania is just difficult, and again, it takes a lot of calls. Once you find somebody in Pennsylvania, if you eventually get through to somebody in Pennsylvania and they're helpful, make sure you get their telephone number, make sure you write it down, and make sure you send that to me so we can use the same person. Anytime we find somebody we like, we will call that person over and over and over again. And to the extent we need to send them flowers or chocolates, we'll do that. Because anytime we can find somebody that helps us, we definitely want to keep continuously using that person. There are options for Pennsylvania as well. You've got the online thing, MyPath, Where's My Refund? And again, you can just continue to call and schedule a call, or you can submit a question electronically. Sometimes that helps. Okay, let's move on. Inflation, just recently in October of 2022, the IRS, and they do this every year. The IRS every year increases things for inflation. That just came out in October. Can you turn my mic off for 1 second? Sorry about that. Mic back? Good. Sorry about that. That just came out a couple weeks ago. You may have seen that. And the only reason we're mentioning it here because, like I said, you may have seen it. The gift tax limit was increased from $16,000 to $17,000, which is important. And I will just add a little tidbit here. If you have parents, family members, people who are older, and they have a taxable estate, just make sure they're doing the annual $17,000 gift because that's an easy way, a free way to get money out of their estate. We find a lot of situations we have wealthy clients and they're not using the $16,000 or $17,000. It's really important to do that. It's a freebie, and you might as well be doing it if you've got a taxable estate. Oh, sorry, went going the wrong way here. That's why. All right, let's shift gears again. Let's talk about some, I call them business-related tax changes. Ryan and I are going to share this part, but just things that we have seen over the last 3 or 4 years with respect to our business clients that's important. First off, foreign reporting. Over the last 5 years, foreign reporting has become a significant issue. It's crazy, the amount of disclosure, if you have anything foreign at all. If you have a business and you're shipping overseas, you need to be paying attention to the new foreign reporting rules. If you have a business and you have a bank account in a foreign country, you need to be reporting under the new foreign reporting rules. Later on this afternoon, Michael's going to talk about Schedules K2 and K3, which I have as the last bullet point here. He'll spend quite a bit of time talking about those because that's something that is new, that was new for 2021 reporting. And I had some partnership returns that the K2 and K3 reporting added 100 pages to a return. So it's significant, it is important. The fines and penalties, if you don't report that, are significant. So make sure you're paying attention to that. And again, it doesn't take much. It doesn't take much to be required to do this foreign reporting. If you go to Permane Brothers and order a Reuben and put Swiss cheese on your sandwich, you have to report it. There are foreign reporting rules for almost everything. If you even think about it's something foreign, you need to report it. So make sure you're paying attention to that because, like I said, those fines and penalties are significant. Bonus depreciation, you want to cover that?
Yeah, bonus depreciation, I mentioned earlier, this was increased to 100% with the Tax Cuts and Jobs Act. It was previously, prior to that, 50%. And that, again, is for the deduction that is allowed on depreciable assets placed in service during the year. 2022 is the last year for the 100% deduction. That is going to be decreasing down to 80% in 2023, and then a 20% drop off every year thereafter. So 60% the following year, 40-20, until it gets down to 0. Now, again, anytime something's phased out that long, chances are there's going to be some loss, some change. Who knows? It might go down to 50% and stay there like it has been for several years prior to then. Net operating loss, let me cover that. These were changed prior to the Tax Cuts and Jobs Act. You could take 100% of your net operating loss for a corporate taxpayer in any given year. So if you have $100,000 of income, but you have, say, $600,000 of NOL carrying forward from the prior year, you can offset your entire taxable income in that year. However, with the Tax Cuts and Jobs Act, I think it was any NOL incurred in a tax year beginning 2018 or after, that was limited at $80,000. So back to my prior example, if you have $100,000 of income, $600,000 NOL available, you're still limited to only offsetting 80% of that current year taxable income. So that's important whenever you're looking for what you're gonna owe in taxes during the year, making sure you know you can't offset all of your taxable income for that.
Yeah, and that's an easy way to get caught with your pants down, and not because you're not expecting it, because, oh, we've got tax law, or we do have taxable income this year, but we've got huge tax losses coming forward. So you got to make sure you're paying attention to when those rules kick in. From a state tax point of view, again, still talking about business-related concerns. For state tax purposes, you got to be careful and make sure you're filing in the right states. You got to make sure you're registered to do business in a state you're doing business in. You got to make sure that you know what the rules are and what the laws are in any particular state, because you don't want to get caught there in the future only to find out that you should have been filing in a particular jurisdiction for the last 10 years and you haven't been filing there. From an income tax point of view, obviously, you might be missing out on carrying net operating losses forward, but if you have taxable income in those states can pull you in. And nexus rules are very broad. It's not something you can determine in 10 minutes. You need to spend some time to determine whether you have a filing responsibility in a particular state. That is especially important for my clients who we know we're going to be selling the business in the next 2, 3, 4 years, because if we know we're going to be selling the business in the next couple of years, we know that somebody's going to come in and do a due diligence study for the buyer. And whenever somebody's doing due diligence for a buyer, they are always going to say, yeah, they should be filing in another 20 states. They should be not filing in another 10 states, whatever the case is. And if that's the case, it's going to reduce the amount they're willing to pay you, or they're going to put a bunch of money in escrow and you're going to have to fix the problem after the fact. So we've got to make sure that you're paying attention, because it is really important, especially if you're planning on selling the business over the next couple of years. Same thing with sales and use tax. You've got to be paying attention to sales and use, because if you're in a state and you're required to collect sales tax and you don't do it, if you get caught, you're going to have to pay that sales tax. And if you think about it, sales tax is what you're collecting from your customer. It's not your tax liability. So if there's any question, you should collect it and remit it to the government. Collect it and remit it to the state, just to make sure you're protecting yourself, because if you do get caught, it's going to come out of your pocket in the future. Changes to the Pennsylvania corporate net income rate, effective starting in 2023. The Pennsylvania corporate tax rate is going to go down. It's going down 1 percentage point in 2023, and then a 0.5 percentage point over the next 5 or 6 years, until it gets all the way down to 4.99%, I believe, in about 2031. It'll be changed 6 times before then, so just know that it is supposed to be falling starting in 2023. Anything else to add there, Brian, either on the business side or state side?
I don't think so.
Okay, good. Mergers and acquisitions. And the reason I threw one slide in here, because we've worked 10 minutes. Thank you. We've done so many acquisitions, so many sales over the last 3 years. COVID was a big deal. The pandemic was obviously a big deal on the M&A side, but we still had a lot of businesses in 2020 that changed hands. We had a lot of businesses, especially in 2021, a lot of activity, both on the buy and the sell side. I had one client that bought 4 companies in 1 year, and then they sold their business at the end of the year. So that was quite the tax return that year. But there was a lot of activity, and a couple things that have changed on the M&A side. There's so many things that are done virtually now that were never done virtually before. I had clients who were, in the beginning due diligence phase. In the beginning due diligence phase, they were doing tour visits. They were touring sites with a telephone or a video camera, so they didn't even go look at the site. So in the very early stages, they would have some type of video tour of the company. We've seen situations where inventories are being done remotely. Now, obviously, in 2020 and 2021, those were mandatory because we couldn't travel and we couldn't go see things. But since companies were still being bought and sold, those things had to happen. They had to happen electronically, and somehow we figured out a way to do it. Also, the closings now, 10 years ago, when you bought a business, you'd sit down with the seller, you'd sign all the paperwork. There'd be a foot and a half of paperwork. Everybody would sign and be happy, and then shake hands and you walk away, or shake hands and you go have a beer. So celebrating the fact that you just closed the business. Now everything's done electronically. I can buy a company in Nashville. Everything gets done electronically, sign everything. Everything gets done in about 10 minutes. Nobody reads any of the documents anymore. You just rely on your professionals, which is fine. That's why you hire us. But you rely on your professionals that everything is the way you thought it was going to be. One of the other things that we see quite a bit of now on the M&A side is when they're on transactions, it is not unusual right before the transaction happened that there's a restructuring of the selling company. And the reason for that is a lot of times, the company might want to sell the assets out of a company, but it's an S corporation, or they might want to sell the assets out of a company, it's an LLC. So a lot of times what we're doing is we're doing a restructuring of the company to get all of the assets that we actually want to sell down into a newly formed company. Whether it's an F reorganization or something similar to an F reorganization. That is very common now. I know 10 years ago it happened, but it seems like every transaction we see now, there's an F reorganization that happens right before the transaction closes, like the moment before it closes. Then there's that F reorganization, new company, and then the buyer comes in and acquires either the LLC units. Generally, it's the LLC units. Almost every transaction we see now is going to be taxed as a partnership because, one, from a formation point of view, almost every new company is formed as an LLC, and then when a company is being acquired, generally the buyer wants to treat the acquisition as if it's a partnership and get the treatment as if it's a partnership. The reason is because you get basis step up. And if you spend $10 million on your manufacturing company and you get to depreciate or amortize that $10 million over the next couple years, that significantly changes your cash flow. And most of our transactions, especially when you're manufacturing companies, we buy a manufacturing company for $10 million, and we can allocate $5 million to the fixed assets. In year one, because of bonus depreciation being at 100%, we're getting a $5 million tax deduction. And from a cash flow point of view, that completely changes our cash flow when we know in the first year or so, because of that massive depreciation, we don't have any tax costs. Recapture issues on the sell side, when you do treat a transaction as a partnership or as an asset sale, on the sell side, you're going to have recapture issues, which means that instead of, if you sell it for $10 million, instead of having a $10 million capital gain, you have potentially a $5 million capital gain and a $5 million of ordinary income because of the recapture rules. One last thing, state tax mandatory withholding issues. If you're selling a business and you're doing business in other states, if you're selling the business, there is very possible that those states have mandatory tax withholding rules, which means that you have to calculate the gain and you have to withhold tax and pay the tax to the state when you file the tax return. It's very important that you know that, because you need to withhold some money from the distributions that you'd normally give your shareholders, and you have to make sure you're paying the states, because if you don't pay the state will reject the state tax return if you're not paying the tax, the withholdings. Okay, let me look at our time here. Okay, we've got 5 minutes. Let's cover the individual real quick, Ryan. You want to take the first one?
Thought that was you.
I will cover it. Individual tax planning strategies and idea from on the individual side. Obviously, deferral strategies. You have to understand and think about what your taxable income is going to be over the next year or so, and decide whether you want it to be a 2022 or a 2023 issue. There are deferral strategies. To the extent you can bunch income, you want to do that when it makes sense. To the extent where you can bunch your itemized deductions, you want to do that as well. The third bullet point down, qualified charitable distributions. For those folks who are have required minimum distributions coming out of retirement accounts, make sure you understand the QCD rules. They're very important. I've got several clients who give a lot of money away to charity, and basically what we're doing is we're making those contributions right out of the IRA or right out of the pension fund, because it eliminates that amount from taxable income, which is a big deal, especially for my clients who don't itemize. If I give $10,000 to the local church, If I make it out of the QCD, it reduces my taxable income. Since I don't itemize, if I just make it as a charitable contribution, I don't get a tax deduction for it. So I'm reducing my taxable income by $10,000 by doing it through a QCD. Make sure you talk to me about that. If you don't understand that, make sure you're paying attention to your parents. If you have parents who have money and they're giving charity or money to charity and they have qualified plans, it's a great way for them to save some tax dollars. And contribution of appreciated assets. This has been something we've talked about numerous times over the years, to the extent that you can give built-in capital gain property to charities and eliminate your taxable income by doing that. Section 199A. With respect to Section 199A, Ryan mentioned that. Make sure you understand if you qualify or not, because there is a 20% deduction on your income from your income if you do qualify. The excess business loss rules, Ryan talked a little bit about that with respect to individuals. Just make sure you're planning for that. I'm going to skip QOZ because we're running out of time. State tax considerations. There is a thing in Pennsylvania, the Educational Improvement Tax Credit, which I use for a lot of my clients. That is for people giving money to schools in Pennsylvania. It's a great program. If you're making contributions to schools, private schools, make sure you talk to me after, because there's a way to get a 90% tax credit on the amount of money that you're giving to those schools. It's a huge, huge, huge benefit. For example, if I'm giving $10,000 a year to a specific school, and we do it through the EITC program, I can set it up so you save $9,000 in Pennsylvania tax. So that $10,000 contribution just turned into a $1,000 contribution as far as cash flow is concerned. And from an individual point of view, making sure you're filing in the right jurisdictions. If you're getting a K-1 from a company that's operating in another state, make sure you're filing in that other state. If you have any activity in another state, make sure you're filing and paying tax to the extent that you have taxable income in the state. You're better off filing a return in a state if it's a 0, just so you start the statute of limitations. You don't want to get a notice from a state and says, yeah, you haven't filed in the last 26 years and now you're in trouble. Last thing you want. Any other Pennsylvania tax savings ideas?
I would say another important thing, if you're a resident in a state and you're paying any state taxes in a non-resident state, so if you're a PA resident paying West Virginia tax, for example, just throwing that state out there, pay attention to that, because you can get a credit on your Pennsylvania return for that. That just acts so that you're not getting double taxed on the same income in different states.
And the very last comment I have, if you have a big gain coming up, you think you're selling your business in Pennsylvania, if you think you have a huge stock gain coming up and you live in Pennsylvania, it's coming up in 2 or 3 years, you've got to move out of Pennsylvania. You're better off living in Florida. Because if you live in Florida, if you're in Florida 2 years from now and you sell your business for $10 million, you're avoiding the Pennsylvania tax if you're a Florida resident. So there's no reason to live in Pennsylvania. There are more reasons to live in Florida from a tax planning point of view if you can save the tax in Pennsylvania. It's a 3% savings on all that income. And I think we're right on time, 9 o'clock, we're done. We will be out to answer questions. Thank you for your time. Everybody clap. We're live again, people. Let's clap. Thank you very much.